Hey everyone, I'm your host Tom Shaughnessy and welcome back to Chain Reaction, a research-driven podcast that's a part of Delphi Digital. If you're not on Delphi's research portal, you're missing out on the critical analysis read by the top minds in the crypto space, so be sure to check it out. One quick housekeeping item, nothing said on this podcast is a solicitation to buy or sell any security or token or to make any financial decisions. Also, all advertisements and podcast sponsors are strictly for informational purposes only and not endorsements of any products or services. I may personally hold tokens mentioned on the podcast, and you can view our show notes below for our complete disclosures. Hey guys, I want to tell you about our new podcast sponsor, Alto IRA. Alto IRA is the leading platform for individuals to invest in alternative assets with IRA savings. These assets include real estate, equity crowdfunding, and yes, cryptocurrency, including Bitcoin. The platform's cost-effective, and it's a hassle-free way to connect IRAs to investments previously hidden from many investors. Visit altoira.com/chainreaction for more information. It's linked in the show notes below. With that, let's jump into the episode. Hey everyone, welcome back to the podcast. Today I have a friend on for a great story that I'm not sure that most people have heard, so I'm excited. It's Dan Hannum, who is the founder and CIO of Hannum Capital Management and the COO of ZenLedger, who was a previous podcast sponsor of ours. So I'm sure you guys have all heard of ZenLedger. Dan, how's it going?
Hey, Tom. It's going great. I appreciate you having me on.
Yeah, appreciate you making the time for it. So, Dan, I like to keep these conversational after doing 100 of them or so. So I'm excited for this. But let's talk a bit about your past life. I mean, we both kind of come from Wall Street, so I'd love to hear where you were before you got sucked into crypto.
Yeah, absolutely, and also congrats on episode 125. That's a big mark.
Thanks, man.
Yeah, my background, like I said, is largely in traditional finance. Had a few different stops on Wall Street, ranging from entry level analyst roles all the way up to junior portfolio management roles, all the way up to eventually a portfolio management role. At my last stop at TD Ameritrade, was always super interested in traditional finance. Obviously, we saw it as kind of a good career path to go in, and I was always, interested in the cross section between, traditional finance, capital markets, economics, game theory, and kind of all that goes into that. And really just wanted to be surrounded by, really intelligent people all pushing forward into kind of uncharted territory. It kind of depends on where you are within traditional finance, if that thesis holds true. But I was lucky to have some stops at some really prestigious firms, work with some really amazing people, and definitely really appreciate that experience, not only in traditional asset management, but in risk management, and being able to carry over kind of the lessons and relationships that I've built along the way into crypto now.
Yeah, that's huge. Were any of your past firms open to crypto or up to speed on it? I'm assuming not, because it's several years ago, but did you float the crypto idea around TD Ameritrade or anything like that, or was it more personal?
It was a little bit of both. I mean, one of the previous stops at Goldman is now kind of back in the news from last week. So I think there's always been like an internal team that's kind of champion on crypto. I think when you get to an institution that large, it's very hard to get buy-in from upper management, especially on an asset class that is deemed pretty risky and has the potential to disrupt their typical business flow. So I think there is always like interest, especially lower into the ranks. I think like during my analyst position when I still had an internship in college, a lot of the rest of the analysts that we were working together on were definitely more interested, more involved. I think we skewed to the younger age demographic, had better interest in virtual currencies, understood kind of the benefits and advantages of using a digital currency. So I think there's definitely like internal champions around each stop. There wasn't really any large scale push. Like you said, this was definitely early on, a couple years ago. So I think most of the firms now have a little bit better understanding. I don't think they're quite there yet, but I think there's different facets and different divisions within kind of these larger firms that are taking a deeper look, whether they're looking at the things that we think are important or not. I guess that's up for a debate. But yeah, so I think there's always kind of an internal crew that was pretty focused on this. I mean, I think we've seen a ton of crossover from whether it's Goldman or Morgan Stanley or TD or another brokerage firm of really talented individuals that have kind of made the leap into crypto. So I think there's always people that are kind of toting the line. I think in the last 3, 4, 5 years or so, it's become less of a career risk per se. I think when I made the jump back in late 15, early 16, I think it was definitely more of like a very sudden movement per se. Definitely met with a lot of strange looks and then a lot of questions. Whereas I think if a banking exec or a finance guy made the transition, nowadays I think it's more of an acceptable career path. But I guess the way I looked at it was that I was young. I had a good resume, had a good experience, had a good degree. I figured I could jump into crypto, and if things didn't work out or if there wasn't really an industry there, I could always kind of fall back on that resume and those connections and, get another job in banking and continue on the latter path towards becoming a partner. But for me at that time, it just wasn't an interest of mine to kind of sit there and wait to become a partner, and then and wait 40, 50 years. And
it's a long wait.
It was. I mean, obviously, there's a lot of perks that come with that, but I was more excited in kind of chasing my passion. And I think that's what I've always told my friends that are still in finance is, if you're jumping over just to make money, like, there's obviously opportunities to make money, but one of the main reasons why I jumped into crypto is that, I was spending my nights, my weekends, my mornings, pretty much all my free time on crypto. And I think that was kind of what really did me in, was that I really wanted to work on something that I felt passionate about and that I felt could really move the needle.
Yeah, it's funny you bring up 2014, 2015. I mean, I got involved in like early 2017, I want to say, but 2014, 2015 just seems like a totally different world. I mean, I know it's only 5 years away, but it just seems like it's 100 years away in crypto.
Yeah. The progress of adoption, in the last couple of years on pretty much all fronts is definitely there. It's been really exciting to kind of have been in the industry this long and really see some of the companies that were around then really grow to become behemoths. And I remember like Brian Armstrong being behind the desk at conferences, trying to promote Coinbase, and now they're I'm pretty sure close to $1 billion, if not higher business now. And then the vice versa. You've seen a lot of companies that were around back in the day that no longer exist. Same thing with people. We've seen a fair share of people come in and out of the crypto market. So it's been an honor to be able to be around for this long, and I'm really excited about the next 5-10 years.
Yeah, no, same here. So basically, your last stop, I think you said, was TD Ameritrade, and then you made the move into crypto full time. Could you walk us through your transition from? I mean, I know you're spending a lot of time, a lot of your personal time at the time in crypto, but how did you formally make the jump from traditional finance to crypto?
Yeah, I think it really started with the passion. Because in my opinion, the passion kind of leads you to opportunity. So being passionate about it, interacting on Bitcoin Talk and Bitcoin forums and Reddit, and just connecting with, not necessarily like-minded individuals, but people that were interested in similar topics or similar kind of technology. So for me, it was really being able to network within the industry before I kind of jumped in and joined full time. So I was able to have some connections with some people through mutual friends, through associates, and introductions from some of my team at the different stops in traditional finance. So I think that was kind of like how the door was originally opened. Well, it was quickly rising the ranks in traditional finance. Was getting into a position where I was managing capital. I think when you get to that position, your window of opportunity starts to really increase. And that was kind of one of the things, was really just being able to adapt that real world experience, those connections, and then the passion of crypto into a role, and was introduced to a few people that were starting different companies in the space. Some were starting, traditional infrastructure type companies, and some were starting more hedge funds, and some were starting more venture capital funds, and some were still trying to formulate what their thesis was, what the mandate was, and how they were going to interact. But yeah, that's kind of how the entryway started. Was connected to Brock Pierce through some mutual friends. This is when he was still back at Blockchain Capital and needed some analyst work done. Really kind of low level, low totem pole type activities of just really digging through and putting together reports and spreadsheets and analysis. And even back then, there really wasn't the same type of crypto asset analysis that we have in traditional finance markets. I think we've seen that grow, from Chris Berninsky's crypto assets book back in 2017 of MV equals PQ. And we've had, a ton of different valuations. Now we're on kind of the big narrative is kind of the stock to flow model. But yeah, back in the day, there weren't really that many models or really ways to value these assets or crypto networks or even down to the protocol layer. So a lot of my time was really spent just digging into data, understanding where trends were going, understanding what type of companies were going to be needed in the crypto space to really make this an enticing space for not only retail, but for institutional. I know we've been on the institutional, narrative for quite some time now, but I think there's, especially in the last couple of weeks, a lot of progress happening on that front. But yeah, that's really how the transition started, was kind of at the right place at the right time, and was able to jump at an opportunity. Like you said, I kind of was at a place earlier on in my career and in my life that I felt that I could make the jump. And if things didn't work out, give it a year or two. And if things didn't work out, I could come back and, stay on the West Coast or whatever and find a banking job or some other type of asset management role. And that was kind of the incentive to jump over. And then that turned into more of a full-time position. And that turned into, joining the team and working on, a lot of our venture specific assets and portfolios that we invested in. And then that kind of led to the ability to start my own fund. And that was kind of a quick overview of what happened in like 2 years and
yeah, Dan, there's a lot to unpack there. It's so I have a couple, I guess, quick questions for you. So some will be easy, some will be probably more in depth. I mean, one of the quicker ones, I mean, a lot of people listening probably, want to get involved in crypto. They don't know how to. You left a top finance job for crypto at a time when the market wasn't really developed. People today have much easier methods of getting, kind of employment in crypto. So let's talk more about, the mental aspect of it. When do you decide mentally, emotionally, on a maturity scale to leave your traditional finance job to take the jump into a new space like crypto? How was your thought process there?
Yeah, I mean, like I said, it's probably like the simple answer, but I think it was really like the main driver was just passion. And I think that was, for me at least, and I know it's kind of shared sentiment along the street, but I think that there's, the ego reputation that you get from joining a firm like that. Obviously, there's financial incentives that you get from joining a top Wall Street firm. But I think there's a lot of people that, jump at that, especially early on in their careers, and get a little bit blinded by kind of like the idealism around that. And I think for me, I just wasn't really fulfilled. I wasn't really satisfied. Obviously, like I loved having my name on a business card and having being able to put, those types of firms on my resume. But waking up in the morning, like I really wasn't that fulfilled to go to work. I didn't feel very driven, very motivated, obviously motivated financially, but, I just didn't feel like I was having a big impact on the world.
It's like you get a huge paycheck, but it's like, what the hell do I spend this on that covers, on my weekend, that covers up the fact that I don't want to go to work all week?
Yeah. And it's funny you mentioned that, 'cause that's kind of the other side of the equation that occurred. I actually, I stopped drinking about a little over 4 years and 2 months, coming up on 4 years and 3 months ago. So right around the time that this transitioning was happening, I think that kind of opened my eyes to a lot of different things. I think, I was a young guy in New York City making a lot of money and spending it as quick as I was making it, which I know is a recurring theme across Wall Street. But yeah, I think that was really one of the biggest impetuses in my life to really kind of reevaluate what I was doing. I kind of realized I didn't really want to be in New York. I wanted to be in a place that had nature. I wanted to be able to go outside and go surfing, go hiking. And as much as I love New York, like it's really a city that's designed for the nightlife, and especially being in traditional finance and banking, like the opportunities to, go spend a couple hours every night going to hang out at the bar or the club or whatever was always there. So I think that was kind of a big change in my life. It was really going the sobriety route and stopping drinking. And that just helped me kind of reevaluate what I wanted, what I was looking for, what was meaningful to me, what was actually important. And then I kind of just saw that there was an opportunity to kind of take a lot of the stuff that I learned at these institutions and apply it to crypto. I think there is a lot of people in crypto at the time, but not many of them came from traditional finance and had that background or experience. A lot of them were more, cypherpunks. They were more on like the CS side, but not really on the traditional finance side. So I think it was kind of a weird combination of different things happening all at the same time that really just made me really kind of pop my head up and just say, what am I doing? What am I spending my time on? And that was kind of the thing that I realized was that, between working 12, 14, 16 hours a day, when I was coming home, I was reading articles, looking at podcasts, looking at markets, trying to understand different protocols, trying to really get my head around protocols themselves. Like my background's in traditional finance, as we've discussed. So like I wasn't really familiar with what a protocol was at the time, or how to evaluate the efficiency of that protocol or token economics, or a lot of the things that we kind of take for granted or kind of common nowadays. So yeah, I think it was a lot of different things that kind of happened all at once. But I guess the two biggest things was kind of following my passion, and then the sobriety aspects. I think that really allowed me to kind of take a step back, really evaluate what I wanted out of the next 2, 3, 5 years of my life, and kind of go chase it.
Yeah, that's awesome, Dad. It's awesome you're open about that. And I guess one kind of ties into the other, though, right? Like you want to go out and party and enjoy that nightlife because the job is so, stressful and, to be honest, sometimes just not fulfilling at the end of the day.
Yeah, and I think there's like every industry has this, but there's a certain level of camaraderie that happens after the office too, and it just happens to be that traditional finance in Wall Street. We like to have that activities happen at nightclubs and bars and restaurants and things like that. So, it was kind of like a badge of honor initially to get invited to those types of things and say, hey, come to dinner with us, or we're going to this place, come meet us here, or whatever. So, it was kind of one of those things where you wanted to jump at that opportunity. Obviously, being kind of young with a couple of dollars in your pocket, you had other opportunities available to you. And it was a really good time. Like as much as that's not my lifestyle now, I'm very glad that I had those years, that I had those experiences, I had those memories, and I think there's a lot of really valuable connections and lifelong connections that I made outside of the office at some of these events and some of these activities. So I think there was kind of that other level of you never wanted to be excluded from activities. And as much as you work really hard and there's long days, there's always the water cooler type conversations, or what happened last night, or what's going on. And so I definitely wanted to be a part of that. I wanted to be kind of a part of the team and be a part of like the culture and the group of guys and girls that were all working together, kind of I think shared similar thoughts of kind of building our own tribe. So yeah, it was an interesting experience to have those experiences, have those memories, and I really wouldn't be the same person without kind of going through that. But I'm definitely glad that I'm on the other side of the table now, and I'll still go out every once in a while, but it's definitely more focused on work nowadays.
Yeah, I like that. It's funny you bring it up as a badge of honor. It's so true. Like you get your first job, you can't wait to go with your boss to client dinners and stuff, and then a couple years later it starts to get old, and then even more so later you're like, all right, I don't even have to be here. If I really want to get a deal done with this guy, I could just call him up during a normal business day, since at that point they kind of trust you. It's kind of different.
Yeah. Like I think there's like the unspoken code of scaling through the ranks. Like you have the work side, but then there's also the personal side. And I think in my experience in traditional finance and in crypto and in most industries, I think that the people that end up succeeding are the ones that can play both sides of the game. I think I've seen, and I'm sure you have, people that have incredible, hard skills and they're incredible workers, or they're very productive. But, when it comes time to having those soft skills, and I'm not necessarily talking about, kissing ass, but just being able to have relationships and having that type of relationship, especially with your boss or the coworkers, is important. And especially in a role like that, you need to have internal allies that are pushing for your success. Most of my internships and like entry level positions and then opportunities to scale up the ranks came from befriending people that were above me, trying to be a sponge and soak up everything I could learn from them. And I think what I've come to realize, especially in crypto, is not to say that I'm at that point or anything, but I think when you get to a point where you can actually look back and start helping people climb through the ranks, it's a very rewarding process. And I think there's kind of that natural transition of learning, understanding, reflecting, and then trying to help the next kind of class or group of people, scale their ranks and achieve their goals and their dreams. So yeah, there's definitely that level of acceptance that was important to me. But I think it was more of understanding that, my bosses were in a position that I wanted to be in. And I think what I've always, been told or give out as advice is, listen to the people that are in the positions you want to be. So I think, it served a lot of purposes. It gave a lot of memories. It was a fun time. But yeah, I think that's one of the things that I don't really miss about, traditional finance is having to play kind of the internal games and the internal politics to get where you're heading. I think in crypto, we're much more focused on, the impact and the performance that you can drive, not necessarily like who you are or where you're located or what your dad does or what business he owns or whatever. It's more kind of principled on your impact. Whereas I think in finance, there's definitely a big aspect of the other kind of soft skills that you need to, master and adapt in order to climb the ranks.
Yeah, I really like that framing. I guess I really loved the how much you learn on Wall Street in such a short amount of time. The Excel skills, the modeling, the analysis, what's important, knowing you only have, 10 seconds or a sentence or a subject line to get someone's attention or to convince them. Like, I really did enjoy that. But to your point, I also did not like the internal politics or kind of the bigger picture on, where's the space kind of going. So I definitely agree with you there. And Dan, just switching gears for the second half of the pod, I'd love to talk about your fund. I mean, so you leave traditional finance in 2015, 2016. You eventually start your own fund. What was that like? I mean, was this like a 6-month process? Is self-funded? Did you have to convince a lot of people? Like, how did that whole transition happen? Because I know we kind of brushed over it kind of quickly.
Yeah. That's that's obviously a big chapter. I think it really happened once again in being in the right place at the right time with, good experience and good resume and good connections. At Blockchain Capital, especially back then, like being able to kind of see what was going on in the industry, there weren't that many VC funds back then. There weren't really that many projects. There weren't really that many companies per se. Like it was still very protocol related. Like Blockchain Capital, DCG. There's a few groups that were kind of leading the way on investments and especially infrastructure type investments. So really, kind of the impetus for my fund kind of started when I got involved with a project and was able to convince a couple of high net worth individuals to get involved in this project, and was able to make them a decent return in a very short amount of time. And they trusted enough through mutual connections and then kind of my past experience to invest a good amount of money, and was able to turn their money into a lot more money in a very quick time. And these are the type of people that are kind of at the top of the ultra high net worth list, which is kind of the office that I left in at TD Ameritrade. That was the last office that I was a part of, was the ultra high net worth individual office. And so I kind of had a familiarity with that level of wealth and kind of the family office practice. And when I kind of reviewed their finances with them, not in that degree, but just kind of like, hey, what type of exposure do you have? And they could check off every single check mark. They had the traditional VC exposure, they had private equity exposure, they had some of their assets allocated to a family office, they had real estate, they had stocks, bonds, equities, commodity. They had every single checkbox kind of marked off except for crypto. And especially in early 16 and then back in early 17, this is kind of the pre-ICO craze where like things weren't popping off 200, 400, 500% in a day, but you're still seeing some really impressive turns that were outweighing what you could get with traditional venture capital. So yeah, was at the right place at the right time, was able to kind of show them that I knew what I was doing. And especially with my background in traditional finance and then being at a pretty significant firm in the crypto space, was able to kind of convince a few of them to take a chance on me. It was a little bit self-funded as well. I put up most of the initial capital to get the structure in place, get our accountant team in hand, get our lawyers in hand, get kind of the structure of the fund in place, and then more fundraising mode. And I was lucky to get one of our kind of staple LPs involved that was able to open up additional doorways, and started off with a pretty smaller fund on the fund size, but I think it ended up being very, very successful in the sense that I think at the time, raising a lot of capital really wasn't that that big of an option. And for me, I always saw that the importance of, especially being on the VC side, the importance of having really amazing LPs was really an outlier in some of the success of traditional VC funds. Having people on board that are willing to give you 3, 5, 7, 9 year lockups, that are willing to kind of see the vision that you have in mind, that are willing to see the value of their assets on paper diminished by 30, 40, 50% to understand that they can get that asymmetric upside on the back end. So I think for me it was really, really important to make sure we had the right people behind us, the right capital behind us, the right structure in place, because the last thing I wanted to do was kind of go the liquid or hedge fund route and have to deal with monthly or quarterly redemptions, and having people have the ability to pull funds and I think that was something that the VC model really helped out with. So the structure of that, and then the structure of our fund and our mandate, I think helped us bring in capital. I think being structured in the way that we were investing in traditional startups via the equity route was something that high net worth individuals and those types of people really understood. I don't think they really understood the protocol investment model or going layer one. So I think that the structure really helped, and then the ability to have some of those connections and some of the resources and teammates and portfolio companies that we had through blockchain capital really opened up doors to get some really good deal flow. And yeah, I think I just got lucky that I was able to get our investors in a deal before I actually started the fund. So they could see our process, they could see the return potential, and then it was an easier conversation to say, "Hey, I'm putting up my own capital. Come join in."
Yeah, that's massively important, especially when you could bring on a deal that's already been successful to kind of show what you're capable of. And you've already made these people money, as you stated. Hey guys, I want to tell you about our new podcast sponsor, Alto IRA. Alto IRA is the leading platform for individuals to invest in alternative assets with IRA savings. These assets include real estate, equity crowdfunding, and yes, cryptocurrency, including Bitcoin. The platform is cost-effective, and it's a hassle-free way to connect IRAs to investments previously hidden from many investors. Visit altoira.com/chainreaction for more information. It's linked in the show notes below. One thing that I've always kind of been interested in, you said you worked in the ultra high net worth group, and you had good relationships there to get those people involved. How do you actually convince somebody that's worth hundreds of millions or billions of dollars to invest in crypto? Because if you're a billionaire, 1% of your money is, in absolute numbers, it's a lot for us, but for them, it's kind of like, is this really worth the headache? So how did you kind of navigate that?
Yeah. I mean, I think it's finding the right people. Like I said, I think that our LPs really were the right people at the right time at the right place that allowed me to kind of have the ability to go take off like we were able to do. So I think for us, it was understanding kind of risk tolerance, understanding their level of comfort with riskier assets. I think when you get to that level, it somewhat becomes a competition of who has what. Like everyone has vacation homes, everyone has the boats and the planes, and like all the types of things that you see on TV or whatever. So it kind of becomes a game of one-upmanship of who can have kind of the next thing, or who can put their money in a place that it's getting the best exposure. And like you said, I think most of these people, if not all of them, had allocations and exposure to pretty much every other asset class except for crypto. And I think they were interested. They wanted to understand how to get involved. Most of our LPs, are in their 60s, 70s. So it's not something where they were going to take the time to understand the markets themselves. And then I think, going the venture capital route, just allow them to understand the structure, and I think that was really important to understand that we were investing in seed and Series A rounds in companies. We weren't investing in open source projects. So I think the way that we set it up was really important. And then at the end, like you said, the amount of wealth is just honestly staggering and astonishing. And I think that was something that I saw, in traditional finance, but really, really saw at my last gig at TD, was just the level of wealth that's out there, and the ability to write what we kind of see as a large check is infinitely small for them. Like a $10 million.
There's so much money out there, bro. It's insane.
It's literally insane. Like I'm not even exaggerating to say that one of our LPs' first checks in the fund was like a smaller amount than what he spends on fueling up his jets for the year. Like that's the type of wealth that we're talking about, where it's like they're spending millions of dollars on gas for jets, and like, so that's where I think it just becomes a whole nother level where, you speak of, traditional venture capital LPs, and you're talking about like, sovereign funds and family offices and endowments and pension funds. We didn't really go that route because I think that they weren't ready at the time. I still think they're, obviously we have other fellow members in the space that are kind of pushing the Get Off Zero, initiative and doing really great work on getting, those types of asset allocators involved, but they weren't really there at this time and they had no interest. So it was really, kind of coagulate, some high net worth individuals that were looking for exposure and put together a roadmap that kind of showed them what we could do. And yeah, like I said, I think that the most important thing for me was really being able to make them money before the fund was actually initiated. Because I think, when
Yeah, that's huge.
Yeah. When you can show your process, it helps.
Yeah, it definitely does. It's crazy that you're kind of describing these guys as, really successful entrepreneurs or people with a lot of money. And to them, it's literally like checking a box, hey, I'm involved in crypto, and one-upping their friends. I'm invested in Dan H, who's, the top guy here. When in reality, the way we think about it is, we think about all the work and research and analysis we have to do. And to them, it's like, it just doesn't matter. It's just funny to think about.
Yeah. Like the first few, quarterly LP meetings were very interesting. It was more of how is the fund doing, how is it performing, than it was necessarily like what is the view or the lens that you're allocating capital from, which was a little bit of a change up for me because it's typically the opposite. It's typically, what's the model, what's the structure, what are we investing in, and then like what the end investment is not meaningless, but once you kind of check off the check marks in the asset that you're allocating to, I think the level of comfort just increases. So it was definitely an interesting first couple months to be able to say, hey, here's what we're doing, here's what we're looking at, here's what we're investing in. For us, having a 7-year lockup for our first fund just gave me the ability to not have to rush into anything. Like I didn't have to rush into projects, especially in 2016 and 2017. We kind of had the ICO craze that was going really wild. And to be fully transparent, like there weren't really that many projects that wanted to raise venture capital. They all wanted to go the ICO route. It was this new craze of, non-dilutive capital and you retain control and, kind of screw the VCs. And that was an interesting phase. So there's definitely some trials and tribulations. It hasn't been, all uphill. There's definitely been some questions around why we went the traditional kind of venture model and not the hedge fund or liquid model. But I think, in the last year and a half, 2 years, starting in 2018, when kind of crypto winter came, I think you started to see a lot of the projects kind of funnel out and more people that had good experience, that were real entrepreneurs, that had exits or had experience, were coming in. They wanted to raise venture capital. They understood the benefits that we could offer them. So it's been a kind of a shift in sentiment. But I think, early on, it was an interesting dialogue to have, LPs that were involved that wanted to see the financial growth, but
Man, what was
weren't all the way in.
was like the biggest issue for you though, raising from these LPs? Like, what was the biggest hurdle? Because I mean, it sounds like everything went well. Like these people knew you made the money. Like you had a clear thesis. Like it all sounds great. But like, what was the biggest kind of thing you had to get over? Was it on a per LP basis or what was it?
I mean, I think it's just venturing out on your own. Like a lot of my success came from being under an umbrella. Like at the end of the day, I had success at Goldman, had success at TD, but you're a cog in a machine, and so being able to use that title or that company allows a certain level of comfort to know that you're not necessarily investing in Dan, you're investing in Dan who works for Goldman Sachs. So there is a level of comfort there, and there still was a level of comfort at Blockchain Capital. I think the biggest thing that I saw was really being, especially now, like I'm 28 years old. So back then I was, 24, 25. So I was on, the really young side of things. I hadn't, I hadn't managed capital outside of a company before. So as much as the story kind of sounds like it was all, sunshines and rainbows, there was a lot of like inner turmoil of getting kind of the first checks in, of being able to kind of, prove or have the dialogue of being able to show that, I can lead a team, I can manage that. I can manage the capital. I can manage our investments. And I think that's something that in my experience, like you don't really see the inner workings of how a fund is structured and managed on the day to day when you're just allocating capital from a traditional financial institution. Like it's so compartmentalized. So if each kind of compartment within the business has its own focus. But when you're managing kind of outside capital under your own umbrella, like you're kind of the end all be all. Like you have to have the right structures in place. You have to be able to bring on team. And I think that's another kind of element of the story that I guess would be interesting to touch on too. It's not just bringing in the LPs; it's bringing in the internal day-to-day team members. So finding the right analysts, the right portfolio managers, the right accounting staff, the right legal staff. Was almost the same amount or even of a bigger challenge to be able to assemble the right team to allow our LPs to have good opportunity for success. So there's definitely a lot of trials and tribulations on the LP side, but I think on convincing people to make the jump into a young company that had I was very ambitious, I still am, but I think that there's a lot of trouble or bumps in the road that happen on scaling the internal team, which allowed us to have smoother relationships with our LPs.
That's awesome. Yeah, no, I'm sure it wasn't all perfect, but it's great to see you did it, and I'm glad you bring up the internal processes. It's such a headache, I'm sure, to figure that out for a fund. And Dan, just switching gears a little bit as to now versus when you started your fund. You started at a time when you could invest in things like Ethereum, but there was also a lot of shady ICOs going on. So I kind of understand why you went the route you did. But if you were starting up a fund today versus when you started yours years ago, is there anything you would change, structure, thesis, process, location? Like, would you do anything differently if you were starting a fund today?
That's a great question. I think there has to be things that you learn along the way. There's things that I've learned in the last couple of years that I didn't even think about before starting the fund. So there's definitely things that you learn along the way. I think if I had like advice for an up and coming analyst or someone that wanted to start their own fund now, I think what I've really learned and I think some recent pieces have highlighted that, like Jeff Dorman at Arca wrote a piece a couple weeks ago that we kind of discussed over the phone of kind of understanding your role within organizations and understanding that you need experience and background, especially in risk management, to be successful. So I think that's something that we've seen, whether it's Adaptive or other funds in the space, that you get some initial success, you see some initial growth within your fund or within what you're working on, and then you go ahead and take outside capital. But I think people don't understand the risks and challenges that come with managing outside capital, not only financially but reputationally. So I think my recommendation is to really be kind of be an Indian before a chief, for lack of better words. Like I think you really need to understand how things work, be around people that are smarter than you, understand how they think, how they process things. So I guess that's something that I would throw out there is it's never too, you don't need to rush into starting your own fund or things like that. Like the timings here, I'm incredibly bullish. I know you and your team are. I'm pretty sure everyone that's been on the podcast is in one way or another bullish on this industry in the next 5-10 years. And I think a big thing in this industry is really reputation. So you can be a very smart guy and raise a fund and blow it. And that can prevent you from having opportunities for the next 20, 30, 40, 50 years. Whereas, if you take 4, 5, 6 years and really kind of, just be a sponge and absorb things, it allows you to not only have greater success in raising your fund, but I think greater success in managing your fund. So I think that's from like a pure kind of fundamental way. I think that's something that I would highlight. And then I think for us, I think if we had, kind of the traditional exposure where you can kind of go up to the 20% threshold before you have to become an RIA, I think that allows you the ability to have exposure to kind of, your high market cap altcoins, which I think can still drive fund performance. I think that's just something that we probably could have done a better job of. Like we have exposure to Bitcoin and Ethereum, but that was mainly structured because we had that exposure through the fund before the LPs came in. So the structure of the fund was a little bit unique, but I guess those are the two things that come to mind is really, where do you think the value is going to accrue? Where do you think you can see the best returns over the next, couple of years? And I think if your horizons are more short term, like in the next 1-3 years, I think there's a lot of value that you can provide your LPs or your investors to go the liquid token route. But I think there's a lot of competition there. I think we've seen that the valuations on that side of the table are still as up in the air, or as they kind of are on the VC side of the crypto table. I think we're seeing, whether it's Dragonfly or Placeholder or other firms that are like CMC. There's a lot of really smart people that are looking to put processes in place of how to properly value these protocols, these layer one networks and things like that. And so I think there's a lot of risks that still come to that. Whereas on the VC model, I think the ability to raise capital is a little bit easier. The ability to manage that capital is a little bit easier. But we haven't really seen these high level acquisitions or IPOs yet. I mean, obviously we see some every now and again, whether it's like a Tagomi to a Coinbase or something like that. But most of the M&A activity is coming through exchanges and not necessarily like the legacy system yet. So I think that there's challenges on both sides. But I guess my summary would be to make sure that you have some experience managing and being in supporting roles before you go out and try to do something on your own. And then just making sure that the structure of your fund allows for the success that you believe is there. And we believed at the time, and we still believe that most of the value accrual will happen on the venture side of the table moving forward.
That's awesome, Dan. Yeah, I definitely agree on taking that supporting role, whether it's an analyst or being an intern or whatever, just so that you know enough about the space. And I love that you bring up Jeff Dorman. We've had him on. I'm close with him as well. And I just love, he just brings such an ice cold, institutional level feel to the space when a lot of people are having philosophical conversations that might not be as important. So I always like seeing his tweets and his combos too.
Yeah, he's a good guy. We got a pretty good group of people, especially here in LA, that kind of have that traditional finance experience, that are now managing capital in crypto. I'm lucky to be in good relations with him and Rain and the rest of the team at Arca, and then you have Travis and Anthony and their team at Ikigai. So it's nice to have some people from traditional finance that are now in prominent roles here in crypto that are in the LA ecosystem. And I'm pretty bullish on crypto, but I'm also equally bullish on LA. But yeah, it's I think the level of conversation and the ability to have very micro level conversations really lends itself when you have that shared experience. And yeah, we're definitely really bullish on both of those teams. And a lot of the other guys that have made the transition, whether you're talking about Mike and Ari into Block Tower, there's a lot of people in the space that take really great care of the reputations of the firm reputations, and have that experience that I think helps push the ecosystem forward at a fast pace.
So Dan, what do you think though long term about institutions putting money into the space when they look at fund managers? Do you think that they're going to look for the people that come from Wall Street, like you and your firm, or do you think that they're going to go for this new era of VC type CIOs that were I hate to say it, but like early in crypto, or built projects and protocols and then kind of built a fund around that? Because it seems like there's a dichotomy between the institutional managers in the space and then the more crypto native CIOs in the space that have built funds around here.
Yeah, great question. I mean, I think there's two sides to this story. I think especially in the last couple of weeks, we've really seen the rise of kind of prime brokerage in this space, which I think just allows the institutions to really come in. And I know that's a narrative that many of us have been kind of saying over the last 2-3 years of, oh, the institutions are coming and they're coming and just wait and whatever. But I think we're really making a big push to have the infrastructure in place, whether it's lending, whether it's custody, whether it's transaction routing, like to really have a full prime broker in the space is really big. So I'm personally really bullish on Bitco and I hate to say it, but kind of on Coinbase. But there's some really amazing companies in the space that are pushing the ability for institutions to get involved and making it really possible for them and easing the risk, but also the day-to-day management of that. I mean, right now when you look at like prime brokers, you're looking at one functionality, but then they're routing orders to 4 or 5 different exchanges, and it's not really seamless yet. So you have to open up accounts at different exchanges, have funds on different exchanges. Like it's doable, but the piping and the infrastructure for institutions to really come in at scale is not really there yet. I mean, obviously we see like Paul Tudor Jones and Rentech that are getting involved with CME and futures and things like that. So I think the institutionalization is an exciting trend. I think one thing to be careful of that we try to kind of pump the brakes on is really the over financialization of crypto. I think if we in the next year or two, if we just map what's happening in traditional finance and that's it, like that's not really that exciting to me. So I think there's still a push to get them involved, but still kind of circumvent a lot of the middleman activities that some of these providers roll. And then on the kind of institutional into VC versus liquid route, I think that's a big discussion as well. Is when you allocate into a liquidly managed portfolio, you need to have the infrastructure in place. You need to know custody. Like there's so much more overhead and day-to-day activity that kind of occur when managing a liquid portfolio than a traditional VC fund. So once again, kind of like the model and the structure and the mandate of your fund makes a big impact on how you're able to allocate and who you're able to allocate from. I personally think that backgrounds, experience, and reputation are important in this space, and I think we've seen that over the last couple of years that the guys or girls that are coming from traditional finance that have a really good background, a really good resume, tend to get a little bit better exposure from that crowd than the crypto native fund manager crowd. I think they're more responsive to kind of the younger millennial type wealth, but a lot of these CIOs at endowments and sovereign wealth, like they're not, in my experience, they're not going to be writing a 10, 25, $50 million check into like a 25-year-old guy that maybe has been in crypto for 5, 6, 7 years, but has no experience managing capital, outside capital. And I think that's a big distinction that a lot of people need to make as well. Is there's a big difference between managing your own portfolio and your own book, whether it's 5, 6, 7 figures, whatever, versus managing outside capital. There's just a massive delta between that. So yeah, I guess that's kind of like my overviews. Is I think the piping and plumbing and infrastructure needed to get institutions involved is continuing to be built. Very excited and bullish on that. But in my perspective, I think those types of asset allocators are me looking more towards the structured investments that they know, they recognize, and especially this early on in an asset class like this, they're going to be looking at pedigree, they're going to be looking at resume, they're going to be looking at connections versus maybe individual experience or individual performance within this asset class.
Yeah, it's a really good detailed answer, Dan. There's a lot of great insight in your answer. I really enjoyed that. And just because we're running a little low on time, and I know we could have a whole podcast episode on this, which we likely should, I kind of want to dig into your thesis on your fund a little bit. I mean, you guys are not really focused on token investments or SAFs or stuff like that. You're more focused on the VC side of things. But I mean, aren't you personally like very interested though in these new models, these new business models, community owned, communities, like all the cool stuff going on in DeFi and Web3 that, they'll never do a capital raise from a VC ever, right? So how do you kind of manage expectations internally where, you can't invest in protocols of your fund, but I mean, personally, you're seeing so much going on in a space that you really can't touch with the fund. Like, how do you manage those two things?
Yeah, great question. I mean, for us, like building up, a partnership of other investors has been really important to us. So, we have Jeff and Rain, we have, Travis and Anthony at Ikigai, and we have kind of a group or collective of people that, whether it's very active or very sparingly, we share deal flow with, people that are looking at, layer one technologies. Like, for example, I spoke with Ashman at Dragonfly a couple weeks ago around a couple different topics that we're looking at. So I think that's really important for us, is to have those, those investors that we trust, that we believe in, that are looking at this space. And then vice versa, there's a lot of things that cross their plate that are on the VC side that they can't touch. So having that dichotomy where we can share deal flow without necessarily overlapping or competing is really important. And then also, I think like what's personally important and personally, may move the needle for me, may not move it for our fund or our LP. So I think that's always the challenge. Is I think there's a lot of really amazing things happening in DeFi. But when you look at D-Force, you look at some of these, recent DeFi hacks from a risk management perspective, like I don't feel very comfortable putting outside capital into these projects at this stage. And I know that's kind of counterintuitive to hear from a VC because, typically the earlier in you are on these protocols or investments, the higher upside you have. But I think there's just a lot of there's a lot of risk that's involved in DeFi. There's a lot of risk that's involved in the the P2P model. I think one of the big things that we're looking at is kind of the theory of like guarded launches for protocols of being able to build, test, then audit, then have a launch, like a smaller scale launch, then have like a managed growth of governance, and then really scale from there. So there's different like DeFi launch models that we're excited about. Obviously with like ETH 2.0 coming up, with Uniswap version 2 coming out, like I said, what got me into the space is really the passion and the excitement and just like the overall curiosity around what can be built here. And that curiosity, sometimes transitions into an acceptable investment, and sometimes it doesn't. So as much as like I might talk about things personally or be interested in them personally, that they always don't, transition over into what's best for our LPs, our employees, our partners, and things like that. So that's kind of one side. And then it's really just kind of looking at like the potential exposure. So like even on the DeFi side, like we may not go protocol side, but we've looked at certain projects that are kind of built around the DeFi, landscape, whether it's like a Radar Relay or whether it's like a Toddle. So there are like companies that are building in this space that are raising outside capital that may not be, necessarily like a protocol. And then you kind of have like the hybrids in a little bit with kind of like the compound model. So I think there's a lot of really amazing work that's happening. There's a lot of really amazing entrepreneurs and investors that are really focusing in this space, whether it's DTC or Dragonfly or there's a million firms that we can name off that have really great exposure. They have really smart minds. I'll even throw Multicoin into that. There's a lot of people in the space that are focusing on that. But yeah, so I guess the big thing for us is really weighing my personal interest and what I think may be important versus what has the biggest bang for our buck, and knowing that my day-to-day activity is being a safeguard and to our LPs, our fund, and what's always spoken about is really fund performance and the upside. But I think managing downside and managing risk is something that doesn't go as noticed or as talked about, but I think is as equally, if not more important, of allowing things that are considerably risky right now to kind of go through the kinks and go through the flows, knowing that there's still, there's still room for having a great investment in those things. But I just think those are some of the things that we're thinking about is just the level and structure of where they are now. And then just kind of the risk involved in investing in those types of assets.
Dan, always a very detailed answer. I like that you're kind of weighing the difference between personal and the fund. And you're right, fund performance always kind of speaks for itself. And Dan, one last question for you here. We're always waiting for institutions to get involved. And you brought up earlier, like there hasn't been a lot of M&A outside of exchanges. When are we going to see a time when, Fidelity starts making billion-dollar acquisitions in the space, or TD Ameritrade or JP Morgan? Because, a lot of people don't want to see it in crypto because they're like, oh, we don't want Wall Street involved. But, the flip side of that is you want outside capital to acquire and grow these companies. You want an active IB and M&A space outside of the, limited funds within crypto. You want to access those, trillions of dollars outside of it. When are we going to see that break where crypto goes mainstream in a good way on that route?
Yeah, great question. I mean, from like my first response from a VC perspective is, you can still raise additional funds through like your portfolio companies, valuations and the rounds that they raise. So even if we're investing in a seed or a Series A round, when they raise their A or B or C, so on and so forth, like we can still go back to our LPs and show, paper gains. And so that's very helpful. Whereas, like there hasn't been that many high profile IPOs. There hasn't been that many high profile M&A activities. So there's still the ability to kind of show paper performance and show the accuracy of your thesis or your model on paper. We'll start to see, we're getting into kind of year 4, year 5. So we're starting to see in the next couple of years how some of our investments shape out. But I think that's one thing that I've always been looking for is how do we get institutions involved? How do we get, that high profile case? And I know we mentioned it kind of early on, like what I've done is in the last, year or so, I've actually joined one of our portfolio companies, ZenLedger, which is a crypto tax accounting software business. And I think the ability to have kind of a high profile exit on that front is really there. And one of the reasons we invested and one of the reasons why I joined the team in a day-to-day role is the ability to, have that path to an exit into an H&R Block and have these kind of legacy institutions get involved. So I think when you talk about legacy institutions or institutional investors in general, or just institutions, I think there's there's different maps and there's different charts or graphs of what kind of bundle of institutions we're looking at. And I think custody is obviously a big one. Accounting is a really big one. Obviously, that's kind of a shameless shill, but I truly believe whether it's retail or on the fund side, having strong accounting is a big thing in our space. Having strong prime brokerage is a big thing. So I think we're starting to build out the plumbing and the infrastructure to get institutions involved. I think it really depends on what vertical you're going to and what are the players in that vertical as to where the path to acquisition or exit leads. Like I said, with ZenLedger, it was pretty clear that we could have a pretty quick and clear path to exit via an exchange or via a legacy accounting firm. And then I think the same thing on different aspects on the mining side. You kind of have the crossover between traditional Bitcoin mining and things like that into traditional gas and energy type minings, whether it's a layer one or whether it's other companies in this space that are kind of bridging the gap between crypto and traditional verticals within that space. So I think that's one thing that we look at is really, and especially from the fund perspective, when we're investing in a company, is what is the potential to have an exit there. So I think that's something that we kind of are always aware of, whether it's through our day to day and my day to day through ZenLedger or my day to day through allocating capital through the fund, is what does the exit map look like? Is there an actual team there? And sometimes the best exits and the best companies don't have that yet. There's not the pot of gold at the end of the rainbow that you're chasing. You're building a very successful company, and the ability to have an exit or some sort of liquidity event happens through building the company and building out the ecosystem. I think that's why we're overall very bullish on crypto. I think we're still in the earlier stages of the high tide lifts all ships type element, where as we continue to progress on prime brokerages, on DeFi, on Bitcoin, on layer one technologies, on infrastructure plays, all these different things kind of coagulate to become a moving force upwards and forwards. And I think that allows different verticals within our industry to have better chances of liquidity or exit events. I guess is kind of the way that I look at it.
Dan, your experience and enthusiasm echoes with every answer. So it's awesome having you on, because I love getting detailed answers to these questions. And we definitely have to do another one of these. So if you're listening, you have an idea on what topic you want me to bring Dan back on, let me know and we'll definitely do that. But Dan, I really enjoyed having you on, and just let people know where they can follow you on Twitter, Hannum Cap, and also to ZenLedger to find out more if they need any help there.
Yeah. Quick shameless shill on Twitter. I'm just at DHannum8, DHANNUM8. Pretty active on Twitter, always commenting on different things or tweeting out things that I'm reading or sharing. So I know Tom and I have had some fun moments go back and forth on some things that we're tweeting out. But yeah, I'm pretty active on Twitter. On the Hannum Capital side, my email is dh@hannumcapitalmanagement.com. So if you're a up-and-coming entrepreneur looking to raise capital, please feel free to get in touch. We have an amazing team and still have some dry powder we're looking to allocate. And on the ZenLedger side, our site is zenledger.io. Especially now in the next 6 weeks with crypto tax season being here, we'd love to be able to help you out and get you situated on your crypto taxes. We offer do-it-yourself plans, but also offer fully prepared CPA plans for investors that just want someone to look over their forms or check off on them and have some help. And then we have a really amazing customer support team that can help you out as well. So if there's anything that I can do to help on any side, I think I'm always happy to hop on a call or hop on an email or chat with anyone that's working within the industry.
Dan, you're relentless. I think you're the first person to ever drop an email on our podcast.
Hey. The no nudie pics or anything too crazy on the email, but if you have I was in that position before where I was looking to raise capital, and it was really important to get in touch with people that I felt were doing the right things, and that's something that I've always tried to keep near and dear to the heart is act with integrity, be respectful, be responsible, and we've had our fair share of deals that come across our desk from some of the partners that we work with, but we've also had random cold calls and random cold emails that have actually turned into investments in getting to know teams that way as well. So we're open to meeting with people.
What's the best cold email if somebody's listening right now and they have a project? Is it like the deck in a sentence? Is it three paragraphs? Is it an essay? What would actually capture your attention?
I mean, for us, I think knowing your audience is big. So if you're going the protocol route or the DeFi route right now, like that's just something that we're not investing in from like a pure protocol layer. So that's just knowing who you're talking to, knowing who you're speaking to, knowing their background, and I think trying to find a way to connect. So like I have a few threads through my history, whether it's traditional finance or whether it's going to the University of South Carolina or having sobriety. So I think finding a mutual connection with someone in a cold call or a cold email is really important. Obviously, don't fabricate that. If you didn't go to the University of South Carolina, don't say you did. But I think having that cold connection is helpful. And then I think for us, it's just showing the value that you can drive to the world. And I think that's something that we look for is really who can benefit from this. And I think obviously with the ZenLedger investment, I think that was something that I personally saw as a pain point. And I think most people in the space back in 2015, 16, 17 were trying to figure out how to get their accountancy done. And there really wasn't that good many good options, if any good options. So I think that's another thing is just research, understand the vertical that you're going at, understand who's playing in the space, understanding what you can offer, that they can't offer, whether it's team, whether it's IP, whether it's whatever. But I guess those are kind of my bullet points, is try to find some sort of mutual connection. Always try to push for a warm intro if you can, so if Tom, and obviously Tom and I know each other, and Tom, co-signs or sends an intro, I think there's the willingness to hop on a call or look at the deal is definitely there. So try to find a warm intro. If you have to go cold, try to find some sort of connection or mutual experience, and then just really be dialed in. Like no one wants to waste time, so make sure when you get that opportunity, you have everything in place. Your deck's on point, your value prop is on point, your pitch is on point. Because typically on a cold email, if you get a shot, you're getting one shot for 15, 20 minutes. So be prepared, be cautious, and be respectful. And I've always been told, you go for the yes until you get the no. So keep following up, keep reaching out to people, and make them tell you yes or make them tell you no. And I think that drive and relentlessness will get you pretty far.
I couldn't agree more, Dan. Everybody wants to invest in someone that's relentless, and it's not annoying if you're could describe and show people that in real time. Well, Dan, this has been an absolute pleasure. Loved your detailed and candid answers, especially because you've been in the space for so long, and you also come from Wall Street, so I really appreciate that. And I'll link, for everyone listening, I'm going to link to Dan's Twitter, Hannum Cap, and ZenLedger in the show notes so you can check out all three. Dan, thanks so much for coming on.
Yeah, Tom, it was a pleasure. Thanks for having me.
Hey, everyone. Thanks for listening to the podcast. If you enjoyed it, please support the show by hitting subscribe on iTunes, writing a review, or sharing this episode on Twitter and LinkedIn. And stay tuned for our next episode, out soon.